In 2025, India's economy powered through the highest U.S. tariffs imposed on any Asia-Pacific nation, maintaining forward momentum to achieve a resilient 7.7% GDP growth. This forecast graphic outlines our expectation for the coming years. Goldman Sachs Research projects India's real GDP will grow at 6.9% in 2026 and 6.8% in 2027. Both figures sit above consensus estimates. Three specific forces are driving this projection: a newly finalized U.S. trade agreement, an aggressive central bank liquidity injection, and a surge in domestic consumption. This combination of policy easing and trade clarity provides a localized buffer for the economy as global conditions shift. The February 2026 U.S.-India trade deal drops reciprocal tariffs on Indian goods from 25% down to 18%. This aligns India's export costs with the 15% to 19% Asian market average, delivering an estimated 0.2 percentage point annualized boost to the country's GDP. Prior to this agreement, U.S. trade policy uncertainty acted as a significant financial headwind, dragging potential GDP down by an estimated 0.3 percentage points. Eliminating that massive cloud of policy friction provides domestic businesses with a clear, predictable runway to plan long-term capital expenditures and scale operations. Shifting to the domestic economy, real private consumption growth is projected to rise 70 basis points, surging to 7.7% year-over-year in 2026. Rural consumption builds momentum on the left, driven by strong winter harvests and state welfare spending. On the right, urban demand rises due to tax relief and a $70 billion central bank liquidity injection, pushing total consumption growth to 7.7%. With both rural and urban demographics spending heavily, this powerful internal demand engine ensures India generates its growth organically, rather than relying strictly on foreign exports. Tracking headline inflation, this gauge starts from a low baseline of 2.2% in 2025. For 2026, our analysts forecast inflation to rise and stabilize exactly at 3.9%, landing perfectly just below the Reserve Bank of India's 4% target. Because price metrics are normalizing near that target, the central bank has limited scope for further policy rate easing, marking an end to the 125 basis points of aggressive cuts executed last year. At the same time, the current account deficit will widen to $37 billion due to high non-oil imports, though continued strong software and business services exports will buffer the impact. Despite that widening external deficit, keeping the inflation rate stabilized near target creates a highly predictable cost environment for domestic businesses. Our baseline GDP forecast of 6.9% is exceptionally strong, but it currently models a lag in actual capital expenditure execution. With trade barriers removed and corporate balance sheets healthy, companies are positioned to accelerate actual CapEx execution in the second half of the year. As outlined in this summary graphic, if that private investment cycle fully executes in the second half of 2026, it presents a distinct upside risk, potentially pushing India's economic growth even higher than current projections.